we brought you all through a lot over the past almost 18 months, but we did it deliberately because it frees us to focus in on the markets that we want to serve, and that includes SMB and B2B in healthcare. With those premium markets and the productivity that Nando and his team are driving, there's an opportunity for continued margin expansion.
Hello, and welcome to the Freight FA Brief. So you beat Wall Street, revenue comes in ahead of estimates, EPS beats the consensus, but your stock drops 5% before the market opens. That's what happened to UPS. And honestly, the market reaction tells you everything you need to know about where we are in this story. Buckle up. Let's get into it. All right, let's start with the raw numbers because the actual headline is a little misleading. UPS posted $21.2 billion in consolidated revenue for Q1. That's down 1.6% year over year. Adjusted earnings per share came in at 107. That beat the Wall Street consensus of 103. On paper, that's a win. But here's where it gets a little complicated. When we talk about net income, it's 26% lower than Q1 of last year. To put that in perspective, that's $864 million versus $1.2 billion 12 months ago. Adjusted operating margin, 6.2%. A year ago, it was 8.2%. That's 200 basis points of compression in 1 year. Free cash flow fell from $1.4 billion to $1.2 billion. Now, before anyone panics, every single one of these numbers is exactly what UPS told you would happen. This isn't a surprise. This is simply the cost of surgery while the patient is still running an operating business that generates $21 billion a quarter. The question is less around the numbers today and more around the strategy and whether that strategy is working. I'm going to argue it is. And here's why. UPS runs three main business segments, and they could not be any different right now. U.S. domestic generated $14.1 billion in revenue. That's down 2.3% from $14.4 billion a year ago. Operating profit came in at $515 million, down from $979 million in Q1 of 2025. That's a 47% drop in domestic operating profit. The adjusted operating margin is 4%, down from 7% last year. But the number that really matters is revenue per piece. This grew 6.5%, while average daily domestic package volume fell from 17 million to approximately 16. So really, that's fewer packages, but more money. So what's the cost per piece? Non-GAAP adjusted cost per piece was $13.35. That's up from $12.19, or approximately 9.5%. That tells you that the network is still carrying overhead for high volume, but that overhead compression is the work of the next 3 quarters. Shifting to international, there was $4.5 billion in revenue, and that's up 3.8% from $4.3 billion. The revenue per piece grew at 10.7%. GAAP operating profit was $547 million. Adjusted operating margin was 12.1%. That's clean, that's healthy, and growing. International is really the bright spot here. As we move on to supply chain solutions, we're looking at $2.5 billion in revenue, down 6.5% from $2.7 billion, and that's primarily a mail innovations volume story. But GAAP operating profit was $205 million compared to just $46 million in Q1 of 2025. That's a 345% improvement in segment operating profit. So the healthcare pivot inside of the segment is the real story here, and it's accelerating. UPS is targeting $20 billion in healthcare revenue by the end of this year. So I would be remiss if I didn't talk about the elephant in the room, which is the Amazon exit. This is really the heart of the entire story. In 2024, Amazon represented roughly 11% of UPS total revenue, but it consumed 20 to 25% of U.S. domestic package volume. So that really amounts to one customer eating 25% of your network. Simply put, the rates don't justify the infrastructure. And that's really a structural problem. Carol Tomé made the call. Cut the volume. It was intentional and strategic. About 1 million Amazon packages per day were removed from the UPS network in 2025. Another 1 million of average daily volume is being cut right now in 2026. The total Amazon revenue being walked away is about $5 billion annually. And in Q1, UPS tendered approximately 977,000 packages per day to the U.S. Postal Service. really offloading low yield residential delivery to the postal network instead. So, really, that's not a carrier in retreat. It's really a carrier making a deliberate choice about what business it wants to be in. I want you to hear how UPS's leadership described the shift.
And as it relates to the Amazon question, at the end of the first quarter, Amazon made up 8.8% of our total revenue. That's down from, gosh, it was north of 13% not very long ago. So really pleased with how we've partnered with Amazon on this glide down. We hold that company in very high regard. And for the volume that we have remaining with Amazon, I think we're going to get to where we want to be. Or we have a great return network. And as you know, returns are the nemesis of anybody who's in the e-commerce space. In fact, 19% of all e-commerce sales are returned. And so with our great reverse network and the capabilities that we have for boxless, labelless returns, that relationship with Amazon is just going to continue to grow. And it's not just returns. In fact, certainly is a key part of it. Give a shout out to the team at Amazon for working with us. We're pleased where we are and want to continue our relationship in the nutritive way that it's turning out to be.
What you just heard is a CEO telling the freight industry that volume is no longer the scorecard. Revenue per piece is now the scorecard. And the 6.5% domestic revenue per piece growth in Q1 with volume down more than 1.4 million packages, it's proof of the concept. So here's my take. I think this is one of the most consequential carrier strategy shifts in a long time. When UPS exit commodity residential delivery, that volume gets absorbed by USPS, by regional carriers, and by Amazon's last mile. Every shipper and 3PL in the audience needs to ask this question. What does the market look like when the world's largest carrier deliberately exits, choosing not to compete for the cheapest freight? It looks like structurally higher pricing. And it's already showing up in the data. So let's take a quick break because I want to talk about something that directly connects with this story. If you're a shipper, a 3PL, a carrier, or a broker, the single most important thing you can do in a market where UPS is engineering yield higher and walking away from volume is know your rates better than your carrier does. That's the problem that Freight FA was built to solve. Freight FA is a freight intelligence platform, a SaaS tool specifically built for supply chains who are tired of negotiating blind. Our core product is Freight GPT, a 24-hour freight analyst at your disposal that gives you real-time freight cost estimates, lane-by-lane pricing intelligence, and market rate visibility across modes. We don't want you relying on a broker quote from 3 weeks ago or a carrier sheet that doesn't reflect what's happening now. Freight GPT gives you AI-driven clarity on what freight should actually cost. I mean, think about the environment we're operating in. UPS is shedding 16 million packages a day of Amazon volume. Tariffs are reshaping trans-Pacific lanes. Capacity is shifting, and every major carrier is pushing yield over volume. That volatility is a problem if you don't have freight intelligence. So go to freightfa.com. That's freightfa.com and see what your freight spend could look like with real data behind every decision. So checking back in with UPS, Amazon wasn't the only story of the earnings call. The parallel story was what is happening inside of UPS's workforce. UPS is cutting 30,000 jobs and closing 24 facilities as it looks to right size for lower volumes. To accelerate those workforce reductions, UPS launched the Driver Choice Program. It's a voluntary buyout of $150,000 to any Teamster represented driver who wants to leave. The International Brotherhood of Teamsters pushed back hard. There were emergency restraining orders in 13 states. The Teamsters' argument was, you cannot restructure our members out of their jobs without bargaining. UPS and the Teamsters reached a settlement in early April. The driver buyout is now capped at 7,500 drivers, with selections made by seniority. UPS also agreed to not launch any other voluntary separation programs for the rest of the Teamster agreement. That agreement runs through July of 2028. So here's the financial weight of that deal. The Driver Choice Program alone accounts for $1.2 billion of the estimated $1.3 billion to $1.5 billion transformation cost that UPS is excluding from this year's adjusted results. The Teamsters settlement also put a limit on how fast the money can be spent and how quickly UPS can reduce driver headcount. Listen to how management framed the workforce piece on the earnings call.
So when we laid out our internal plans for the driver buyout, we wanted to land on 7,500 positions. Our program was oversubscribed, so we had more drivers applying than we could accept. we accepted the 7,500. We couldn't be more happy.
And Stephanie, I would say that aligns with the pace of the cost takeout that we had laid out at the beginning of the year. We feel very comfortable that we're going to get to the $3 billion as we laid out. And
you might say, well, why didn't you take more in? Well, we have to run the business. This is what we needed to run our business.
What you're hearing is a company threading a very tight needle. 7,500 exits is still meaningful, but it's not the open-ended program UPS initially wanted. Here's the financial consequence for anyone modeling this. The non-GAAP adjusted domestic cost per piece rose 9.5% year over year to $13.35 in Q1. That's not just about transformation. That's about labor structure and how fast UPS can compress. UPS captured $600 million in program cost savings in Q1 alone, and that's against a target full year $3 billion year-over-year savings. So that's about 20% of the annual target, all in one quarter. So the pace is real, but due to the restrictions of the settlement, the other 80% is going to take some work. And that will most likely come through network automation, some consolidation within facilities, and route optimization. Before we end, I want to spend 2 minutes on the macro because UPS literally wrote it in their forward-looking statements. They called out changes in global trade policy and geopolitical uncertainty, along with government shutdowns, all contributing to 2026 material risk factors. Here's the specific exposure. UPS's international was the bright spot this quarter, but that segment is exposed to trans-Pacific trade flows. And that's not including the tariff environment compressing U.S.-China volumes. If international revenue per piece starts to contract in Q2 and Q3, UPS will lose its strongest performer. And that's a real risk. So let's bring it home now. If you're a shipper, carrier pricing power is moving structurally higher. UPS adjusted domestic cost per piece is up 9.5%. If you're a 3PL or broker, UPS is actively hunting SMB and B2B volume to replace the 1.4 million packages per day that they've shed with Amazon. So that's really your opening. They want customers. Use that as leverage. So that's it for today. If you've enjoyed this episode, make sure to share it with a colleague. And head to LinkedIn where you can follow us at the Freight Flow Advisor. And listen, every podcast episode comes with a curated Substack article full of in-depth analysis. So head over to substack.com and search the Freight FA Brief. Lastly, you can listen to this podcast on Substack, Apple, Spotify, and YouTube. Until next time, this has been your Freight Flow Advisor Brief.